Most people could not find the Strait of Hormuz on a map if their life depended on it. And yet, this week, a narrow stretch of water most Americans have never heard of moved billions of dollars across global markets in a matter of hours. Oil prices spiked, energy stocks jumped, technology stocks, the same companies driving nearly every retirement account in the country, sold off hard. Utilities and consumer staples, the unglamorous, almost boring corners of the market, suddenly became the place investors wanted to be. None of this happened because a single ship was actually stopped or a single barrel of oil failed to reach its destination. It happened because of a threat, a possibility, a headline about a blockade that had not yet materially changed the physical flow of anything. This is one of the strangest and most important truths about how markets actually work. They do not wait for disaster to arrive before pricing it in. They move on the mere probability that it might. And understanding this single mechanism will teach you more about risk than almost anything else in finance. To understand why a single waterway can shake markets this violently, it helps to understand exactly what makes it so valuable in the first place. The Strait of Hormuz is a narrow passage separating the Persian Gulf from the open ocean, and an enormous share of the world's seaborne oil exports must physically pass through it to reach global buyers. There is no easy detour. Ships cannot simply reroute around a geographic bottleneck the way a driver reroutes around a closed highway exit. This is what economists mean by a choke point, a place where geography itself grants enormous leverage to whoever controls or threatens to control it, regardless of that country's overall economic size or military strength. A relatively small stretch of water becomes, in moments like this, one of the most consequential pieces of real estate on the planet, simply because so much of the global economy depends on oil continuing to flow through it uninterrupted. This is a lesson in itself. Economic power does not always come from size or wealth. Sometimes it comes from sitting in exactly the right place at exactly the right moment.
What makes this week's reaction so instructive is that markets did not wait for an actual disruption before repricing risk. The moment a blockade was announced, paired with talk of new fees on cargo passing through the strait, oil prices jumped and energy-sensitive stocks moved immediately, long before any tanker was actually delayed or turned away. This is the concept of a risk premium in its purest, most visible form. Markets do not price the world as it currently is. They price a probability-weighted average of every plausible future. And when a new serious possibility of disruption enters that calculation, prices adjust instantly to reflect it, even if the disruption itself never actually happens. This is why oil can spike on a threat and later fall just as quickly if that threat fades without incident. The commodity itself never changed. What changed was the market's estimate of how likely a bad outcome had become. And that estimate, more than any physical barrel of crude, is what actually moves the price on any given day. The most visible fingerprint of fear in a moment like this shows up not in any single stock, but in the pattern of money moving between entire sectors at once. On the same day that chip and technology stocks were sliding, utilities and consumer staples, companies that sell electricity, water, toothpaste, and canned soup, held steady or even climbed. This kind of rotation is one of the clearest, most reliable signals available for reading the market's emotional temperature in real time. Growth-oriented technology companies depend on optimistic assumptions about the future, cheap capital, stable supply chains, uninterrupted global commerce. Utilities and staples depend on almost none of that. People still need electricity and groceries whether or not a shipping lane in the Middle East stays open. When investors begin favoring the second group over the first, it is rarely a statement about which businesses are more exciting. It is a quiet, collective vote for safety over ambition, made by millions of individual decisions happening simultaneously, visible only when you step back and look at where the money actually flowed.
History offers a sobering, well-documented precedent for what happens when oil-producing regions restrict global supply, even temporarily. In the early 1970s, an oil embargo led by major Middle Eastern producers caused prices to spike dramatically within months, triggering fuel shortages, long lines at gas stations across the United States, and a period of stagnant growth combined with high inflation that reshaped economic policy for a generation. That crisis did not stay contained to the energy sector. It rippled into transportation costs, manufacturing costs, food prices, and household budgets across the entire economy, proving that an energy shock is rarely just an energy story. It becomes almost immediately an everything story, because virtually every product in a modern economy depends somewhere along its supply chain on the cost of moving goods and generating power. This history does not predict exactly what happens next in today's situation, and no serious analyst would claim otherwise. But it does explain why markets react to oil-related threats with a level of urgency that might otherwise seem disproportionate to a single regional conflict. This is the deeper reason a spike in oil prices functions almost like an invisible tax, reaching into businesses that have nothing to do with energy at all. A furniture company pays more to ship its products. A plastics manufacturer pays more for petroleum-based raw materials. An airline pays more to fuel every flight. A grocery chain pays more to transport produce across the country. None of these businesses drill for oil or trade energy contracts, yet all of them absorb higher costs the moment crude prices rise, and those costs eventually flow toward consumers in the form of higher prices on completely unrelated goods and services. This is why energy shocks are treated with such seriousness by economists and central bankers alike. They rarely stay confined to a single industry. They quietly raise the cost of doing almost everything, functioning as a kind of tax that nobody voted for and no government collects directly, yet nearly every household ends up paying anyway, through higher prices at the pump, the grocery store, and everywhere goods must travel to reach them.
Not every business suffers equally during a moment like this, and one sector in particular tends to benefit directly from rising geopolitical tension rather than merely surviving it. Defense contractors, the companies building military equipment, aircraft, and security systems for governments around the world, often see demand accelerate precisely when instability increases. This week, a major European defense manufacturer reported record order backlogs, driven by governments across the continent increasing military spending in response to a more unpredictable security environment. This represents a different, less discussed category of growth stock, one whose fortunes rise not from innovation or consumer enthusiasm, but from fear itself, becoming a durable, budgeted line item in national governments around the world. It is an uncomfortable category to think about, profiting from a world that feels less safe, but it is also a real and observable pattern in how capital moves during periods of heightened tension, and ignoring it means missing an entire dimension of how modern markets actually respond to geopolitical risk. Energy prices rarely stay isolated from monetary policy for long, and this is where a regional conflict on the other side of the world eventually reaches into decisions made by central bankers thousands of miles away. Rising oil prices tend to push inflation expectations higher because energy costs feed directly into the price of nearly everything else in an economy. When inflation expectations rise, central banks face a harder version of an already difficult balancing act, weighing the need to keep prices under control against the risk of slowing an economy that may already be facing headwinds from the same geopolitical tension driving prices up in the first place. This is why bond markets,
not just stock markets, tend to react sharply to sustained oil price increases, as investors reassess how quickly interest rates might need to move in response. A conflict thousands of miles from Wall Street can, within days, alter the calculus facing policymakers responsible for the cost of borrowing on every mortgage, car loan, and business expansion across an entire country. A reminder of just how tightly connected global energy markets and domestic financial conditions have become. For an ordinary investor, geopolitical risk feels fundamentally different from the kind of risk found in a single company's earnings report, and this difference deserves honest acknowledgement rather than false confidence. A company's quarterly results can be modeled, forecasted, and analyzed with real data built from years of prior performance. A blockade threat, a regional conflict, a sudden diplomatic escalation cannot be modeled with anything close to that precision, because it depends on political decisions made by individuals whose intentions are not fully knowable in advance, even to sophisticated intelligence agencies. This uncertainty is genuinely uncomfortable, and no amount of analysis fully resolves it. The honest position for an investor to take is not false certainty in either direction, not confident predictions that the situation will resolve peacefully, nor confident predictions of prolonged catastrophe. It is the humility to recognize that this category of risk resists precise forecasting entirely, and that the appropriate response is not prediction, but preparation. A subtle but important distinction that separates thoughtful investors from those who mistake confident guessing for genuine analysis. Preparation in this context has very little to do with correctly guessing which headline will dominate next month's news cycle. It has everything to do with building a portfolio structured to survive shocks nobody can specifically predict, rather than one optimized for a single comfortable, uninterrupted future. This means holding a genuine mix of assets that do not all move in the same direction at the same time. Some exposure to defensive sectors that hold steady during fear, some exposure to growth that compounds during calm, and enough cash or stable holdings that a sudden downturn does not force a panicked sale at the worst possible moment. None of this requires predicting whether tensions in the Middle East will escalate or ease in the coming weeks. It requires accepting as a permanent feature of investing, rather than a temporary inconvenience, that unpredictable shocks will periodically arrive from directions nobody was watching closely, and that the only reliable defense against an unpredictable future is a portfolio built with that unpredictability already assumed, rather than one built on the comfortable illusion that today's calm conditions will simply continue indefinitely. It is worth remembering, without becoming complacent, that markets have absorbed shocks like this many times before, across many decades. Wars, embargoes, blockade threats, currency crises, and emerged over sufficiently long stretches of time, having continued to grow. This is not a guarantee about what happens next, and nobody honest about markets would offer one. Individual companies fail. Entire sectors get reshaped by prolonged conflict. Some shocks genuinely do mark turning points rather than temporary detours. But the broader pattern across long financial history leans toward resilience for diversified, patient capital, not because markets are immune to crisis, but because human economic activity has repeatedly found ways to adapt around disruption, rerouting supply chains, developing alternative energy sources, adjusting trade relationships, even when the adaptation takes years rather than days. The investor who sells everything in a moment of panic locks in the damage permanently. The investor who stays anchored to a long-term plan, adjusted sensibly rather than abandoned entirely, gives that historical pattern of resilience the time it actually needs to play out. A narrow strip of water on the other side of the world just reminded millions of investors in the space of a single trading day how connected everything really is. The price of gasoline,
the value of a retirement account, the cost of a bag of groceries, the order books of defense manufacturers thousands of miles from any battlefield. All of it moved because of a threat, not a fact, a possibility rather than a certainty. This is the nature of risk in a global economy. It rarely announces itself politely, and it rarely waits for confirmation before demanding a price. What separates a resilient investor from a fragile one is not the ability to predict which choke point, which conflict, or which headline will move markets next. It is having already built something sturdy enough to absorb whichever one arrives, so that the next unpredictable Friday morning headline becomes a moment to observe with steady attention, rather than a crisis capable of undoing years of careful, patient work.